Hello, David. Good to see you today.
Well, welcome everybody. This is TCA Crossroads. It certainly is a place where entrepreneurs and investors have a chance to see, listen, and learn. So, David, I'm kind of happy. It's the beginning of summertime. A lot to talk about. A lot is going on in this industry. And let's just get started.
Yeah, I'm excited because, we make investments. The real goal is to get something out at the end. And I think you're going to help us understand what that begin with the end in mind game looks like, right?
And it's true. Today we're going to talk about the last 5 years of M&A deal terms and the difference in what's happened during this time, and look at the 2026 SRS Acquiom. So the first thing to know is that we are looking at exit timing that if you look at the number of years, most exits happen at 9+ years. I know angels don't like to hear this, and it is a combination of angel and venture, as you're going to see, but that is where we are. So if we look at the average value of the average exit between angels and ventures in 2025, it was 95 million. And if we go back just 5 years, that was half of that, almost 53
Wow.
million. Yeah, I know. And so we are getting bigger exits by far. We're getting them take a little longer time if you look at that chart. And now we're going to delve into it and see what that means. So who is buying these companies? What kind of buyers? So the green are U.S. public companies. Public companies actually account for a slightly lower number, 37%, 32% of acquisitions now compared to 10 years ago when it was 44%. So private companies and other forms we're going to talk about account for more of the activity now than before. So private equity, black, that's the second one down, 14% up from 12%. U.S. privates, and that would be PEs and PE-based other companies. You're looking now at the two levels of blue. And then finally, non-U.S. based, 15% up from 11%. So not too much of a change now that I look at that. It looked much grander when I first saw it because there were fewer public companies buying. Closing consideration. This one is really interesting. Go back to 2018. Look at the difference. It was all cash, 87% back in 2011 or 18, and now it's 51%. But look at the amount of management rollover that has taken over that didn't even exist back in 2018. 21% of all deals now include management having to take part of the equity in the buyer to be able to continue. What a difference. So that consideration has kind of played itself out. Although you have to notice that this happens as much in deals which are marginal as it does in deals which are very good. David, any thoughts about that?
Yeah, I have two thoughts. For one thing, well, I'm still stuck on that the first slide where you mentioned that the average is $95 million today, which is twice as great as the exit. So I just want to point out, if you have a 10x return without dilution, if you invest 9.5 million, you get your 10x return in 9 years. You're only at a 26% compounded annual growth rate, IRR. But I do like this slide for one reason. I do like the fact that management would be involved in the deals, so they would have to get their return. They would have to continue to be involved and help that company grow. That's what I'm getting out of this slide. I don't know if you're seeing the same thing that I am.
I have. One of my deals, Tech Coast Angel deal, we had to keep one senior manager in. He was unhappy because he had to take 15% of his consideration in stock of the buyer. And we compensated him with an extra $1 million to allow him to do that. So you never know, but that certainly is a trend that we're seeing a lot of. Transaction values. If you look at the values that we see based upon us being the lower end of all of this, 27% of the deals are under 25 million. And that is down from 33% back in 2016, I don't think I'm too surprised by that. And there aren't really many things that have changed too much, except perhaps maybe it is the very top 4% of the deals had been over 75 million in 2016, and now it's up to 9%. But those are not big changes. But now just look at the big picture. Most deals, 27%, are done under 25 million. And I have always said that the sweet spot for us as investors from Tech Coast Angels is around 35 to 45 million. And if you add the light and dark green, which gets a little above that, it gets to over 100 million. Let's just take the light green. That's 16% of all deals. A surprise to me, because that would ordinarily be a higher number in my experience. But if you add the 16 and 27, that's almost half of all deals are done under $50 million. That makes a lot of sense to me.
Yep.
Okay, transaction values as multiples of the capital invested. I like this slide. We don't normally talk about this in this same way, but the multiple of the capital invested is 3.3x on the median and 6.5x on the mean or average in 2025. And that hasn't changed much at all from 2020. So what we're looking at is kind of a yardstick for us. The median average deal, that means the largest deal, is 3.3x. But if we take all the deals and divide by the number of deals, that is 6.5x. And that is what we're seeing, or have been seeing, for SaaS deals. So it's a good sign to see that some of these companies that are not SaaS companies are getting valuations that are that high. I believe since you take the total of all deals in dollars and divide it by the total of all deals in number, you're speaking of SaaS companies, non-SaaS companies, and very, very big companies as well as small. So it might be distorted. Either way, I love that number at 6.5x. Management carve-outs. Well, now I said that 20% of the people are taking that, but it's happening in only 4.3% of all the deals. What's the difference there? It is that many deals are very successful. And so those deals aren't requiring the management carve-outs, but those that do are requiring 20% of the money being taken by management. And that is where I think many of the times lately, our angel investors have left companies with management having to stick around when perhaps they didn't want to. But now if we add venture, 4.3% sounds a lot better, but that's the number of deals that require this. In the earnouts of non-life science deals, it has changed, but only because we had some anomaly years like 2021. But what you're looking at is earnouts based upon revenue are predominantly the way in which earnouts occur. I kind of hate earnouts, but they are a fact of life nowadays. And you're going to see that 74% of deals this last year required earnouts in one form or another. We may be talking in a minute about how much those earnouts are, but it just means that all cash deals are becoming rarer, earnouts are becoming greater. And if we look at the types of deals, most of them are based on revenue. Some, about a third of those, are based on earnings, and some are based upon other things like milestones. So earnouts based upon revenue. David, think about that for a second. Any comments?
Yeah, I tend to buy into it, and I happen to like the fact that when a company buys a company, they're buying the product market fit, but they're also buying the executive team. They want that executive team to stay so that that company could be more successful. The companies that I've been with, both on the corporate side, when we've had our company bought out, also included earnouts. I don't know of any company that I've been involved in where my company was bought out had anything but an earnout. I mean, we varied in percentage, but it was always relatively pretty good. 20% would be additional 20% you would be able to gain through an earnout. That was a positive.
2 slides from now, I'm going to talk about how those earnouts are achieved, and that's going to be a little bit of an eye opener. But in the
Okay.
meantime, let's look at the non-life science deal earnouts, and these are the deals in which earnouts were included. And you'll see that 2021 aside, we have 24% of our deals right now that are requiring earnouts, and that's a pretty big deal. 68% of them had a trigger based upon multiple events. That becomes something where people begin to push back, because you might think of the buyer changing a business in many ways after that business is acquired. And when that happens, the seller will always argue, sometimes sue, because those earnouts no longer are based upon the same rules as when that deal was done.
Yeah,
I
great
can
point.
speak to experience
Great
about
point.
that one. So here's that slide I talked about. Here's the achievement overview. Based upon the number of deals, 59% of those deals had earnouts that were achieved, and the inverse were not. If we look at dollars, however, that's a different story. Only 21% of them actually got the potential that was paid or meant to be paid when the earnout was expected. So 79% of the deals never reached the earnout of the potential, or at least the expectation of the seller.
Yep.
Ouch. And so if we look at the achievement overview, if we take 100 deals with earnouts that were in the database that we happen to look at from SRS Acquiom, there were $9.6 billion in the aggregate transaction value of the deals. 3.6 billion was the potential earnouts, and 28% of those where the earnouts were contested. And 17% of the deals were the contested earnout where the seller successfully actually got their earnout. That's not a high number. So the aggregate additional earnout payments as a result of renegotiations, 132 million bucks. 3% of the deals in those data sets where earnouts were disputed and resolved by litigation or arbitration, so that number of deals finally got done. So I was a little bit strange in the way I said that, but let's look at that number one more time. Out of 100 deals, 3% actually had to be arbitrated to get the 17% that resulted in the same number as the expectation. Wow. It's a warning for all of us, and yet that's the market we're in right now. The all cash deals are down, the earnouts are up, the contested earnouts are up, as you might expect, and it is just something we know when we sell our companies. So if we continue with this, the earnouts, again for non-life science deals, what is the length of an earnout typically? Well, today there are very few, well, maybe a quarter, that's not very few, that are 1 year or less. I have never seen one, so it's something to celebrate. But 1 to 2 years, it happens to be 2 years is the typical term of an earnout that I've been dealing with all these years. And it's 38%. And 2 to 3 years, 20%. So that average is pretty much what we've been experiencing as angels in deals we've been involved in the sales we've made. So the purchase price adjustments post-closing, based upon not just the earnouts not having been made, but the adjustment to the purchase price, which can include lots of reasons. Working capital adjustments. I know that you're aware, David, but many people are not. When you have a deal that you sell, you leave enough cash in the deal for the buyer to be able to operate for some number of months. Otherwise, the buyer has to add working capital. Well, what if you haven't left enough? Then there's an adjustment to the purchase price based upon any kind of a holdback. And those based on working capital, 88%, meaning that almost every single deal done in 2024 and 2025 required that. Next, there's the adjustment based upon cash. It's the amount of cash that is changed based upon a missed adjustment, or an adjustment that was made. And sometimes it is based upon the amount that is still owed on a deal, the debt. And then there are other reasons as well. So most of the deals removed from cash based upon post-closing price adjustments. And quite a few deals also do the same with debt.
Understandable. I mean, things change. There are hidden things that come up when you are now operating the business. Doesn't surprise me that there would be changes. It surprises me that number's that high. That's all.
Me too. So if we look at those purchase price adjustments again, excluding tax-related items, it's 11% are based upon changes in GAAP practices.
Yeah.
We're going to talk about that in just a second. And the rest of them are all the other things that can happen. Changes in GAAP practices. Most of us are selling private companies that attempt as best they can to be GAAP compliant. But it turns out that most small companies have a hard time doing that. And public companies, especially very large buyers, are forced into GAAP compliance and therefore have adjustments that they make based upon these sellers and the way in which the books were represented based upon GAAP differences. So that's a giant number, and it certainly makes sense. But most small businesses being sold don't realize that that's a risk in making the sale when the books are not GAAP compliant. Here's one where purchase price claims and surpluses as initially calculated are really something for us to look at. 34% of the deals, the buyer proposed a surplus and they turned out to be seller favorable, meaning the seller actually made more money than the actual original purchase price. David, you and I participated, I guess, in Influential, which was a Tech Close Angels deal. We thought it was going to be a $500 million deal, and it was a $750 million deal because, again, the buyer proposed how that was going to be handled as far as a payout based upon earnout, and the company exceeded it dramatically.
And I was happy, by the way.
I'm glad you were an investor.
That's right.
57%, however, went the other way. And that is more typical, where you didn't get anywhere near what you thought you were going to get. So how about the contested claims for surpluses? The deals with initial purchase price adjustment claims, which were buyer favorable, turned out to be 57%. 22% were disputed, and 34%, the same number we saw a while ago, are the ones where the seller benefited because of these claims and surpluses. Once again, the buyer is the wise one, unfortunately. How long does it take to resolve a claim? That's interesting. We haven't dealt with that one before. It's 14 months to resolve an undisputed liability. If it's about customer contracts, it's 7 months. If it's employee-related claims, it's about 6 months. If it's financial statements, they can do that fast. It's 4.5 months. And then you'll see a lot of others like tax down at 1.3 months. But the idea is, if it's undisputed liability, you don't know for a long time. For instance, somebody suing you or something of the kind. An average of 14.3 months before it can be settled. But how about cybersecurity representations? They are being required now 95% of the time. They're being omitted only 5% of the time.
Yeah, so this is interesting too, because I wonder if the cybersecurity representation will impinge upon the liability. There's a hidden, because maybe your data was breached, hacked. So I don't know if it's available, but it would be interesting to note how this affects the elements of where the liability is or where the disputes are. But I can see cybersecurity problems mounting up with an undisclosed liability somewhere down the line. Or maybe it's, the deal is closed and all of a sudden you find out there was a breach that was never reported. I come out of the cybersecurity industry, so I was just thinking out loud about that.
There's no slide here to talk about it, but almost all the deals that I'm involved in now require cybersecurity insurance. And then one more slide, the general survival period, the time to assert claims. How long does it take for the seller to hear from the buyer that there is a claim. Now, we saw how long it took to dispute and how long to resolve, but here it comes. To make the claim, only about 18% of those claims are made before 12 months. And if you look at the 12-month period when many of these survivals expire, a lot of claims, 34%, are made. And so you can expect to wait a year before you hear the bad news if you're a seller. And then 12 to 18 months, about 13%, and 18 months or more, about 26%, and then it gets lower and lower after that. So if you're a seller, you're going to wait for the sword of Damocles for about a year, and then you're going to hear all this news from the buyer pushing against the things that are held back, whether it's a note, whether it is a holdback in cash, whether it is an earnout, anything, about a year, and then you're going to have to fight it.
But it's interesting because the timing is coincidental with the 24 months for the earnouts in general. So what my mind went to this slide vis-a-vis the other, and I overlaid them. So I think there's a correlation, and that's why from a buyer's perspective, you want that earnout. And from a seller's perspective, you have 2 years when you're still the management to make you to help improve the earnout situation, but also reduce the claim situation.
I think you're right. So let me just summarize in a sentence or two. First of all, fewer all cash deals. That's a big deal. Management holdback are often required, meaning senior management is required to take some of the stock of a buyer. It takes longer to resolve any claims that are made. Cybersecurity claims are much more common than they used to be. And it turns out that there are more disputed deals than there used to be. So it's a more complex environment. David, final idea? Final thoughts?
No, I think you hit the nail on the head. I think your summary is spot on. I keep coming back to that first slide because we as angels want to see that unicorn. We want to see that big, a high value deal come out after the M&A. But again, the numbers indicate that the graph is more towards the lower end. So again, it goes back to an earlier point that you raised many, many times. The initial valuation and that deal structure becomes really critical in making an intelligent decision on what you want to invest, because as Stephen Covey said, begin with the end in mind. And the end in mind is pretty clear that the probability is going to be on the lower end, not the higher end. And if you have additional rounds and dilution, you kind of may want to look at other options in terms of the way you want to recover your money, because the MOIC won't be there necessarily to give you that high return.
And you know how many times I've been talking about that. A $50 million deal sounds great, but if you came in at 10 million, that's 5X. And 5X does not make up for all your losers. If you came in at 2.5, it's 20X. And you can brag about 20X big time. And if you came in at 1.25, that's 40X. And now we're getting into the area where we can brag for years.
Well, that's finding that needle in that haystack, which is what we all want to try to find. And I love it. I think it's great. Great job, Dave. I really enjoyed this. It makes you really think. Do you want to pull it to a conclusion?
Nope. I think I've done all I have to do. Take us out.
All right. Well, listen, on behalf of David Berkus, David Friedman, and TCA Crossroads, we wish you the best in success in investing and hope you learned a few lessons from today's presentation by Dave. With that in mind, wish you good investing long term.